started with the show today. We are joined by Blume Ventures, and we have Karthik Reddy, the co-founder and managing partner at Blume Ventures, joining in with us. Now, they've recently just announced an inaugural fund that has come in as well. Now, what more is it about the fund? What are they focusing on? Let's bring on board Karthik Reddy joining in with us this evening. Karthik, thank you so much for joining in with us this evening on ET Now. It's a pleasure having you on the show. I want to start by talking about, you're launching the inaugural fund, Fund 1, and this is along with an extension fund 1A, and this has actually realized as much as 5 times of the invested capital so far. So, that's a very, very interesting number that has come in. Could you just start by talking to us and tell us more about this fund, what does this mean as well, and about the company?
So, it's been quite a journey. We're in our 13th year of that cycle. Fund 1A was started about 3-4 years into the journey to be able to give us more firepower for reserves into those best companies. So little younger than Fund 1, but it allowed us to build whatever we did in terms of reputation, in terms of brand, in terms of portfolio for the first 4-5 years of our existence. So very grateful to those investors. But also, if you were with us in those rooms, you would see how cynical the investors were on whether we'd actually be pulling this off. I've had many investors say, hey, we know you're nice guys, so here, take 1 crore, which we had set as the minimum at that point. And some even 3, 4, 5 years in, after reading the quarterly report, said, yeah, there's some movement, but we really don't know whether this is going to pay off. Will we even get our principal back? And so we had to take a lot of that along the journey. And I think we're obviously almost always grateful to the entrepreneurs who pull us through. Their journey is effectively, we are a derivative of their success. And to the credit of those folks, they kept at it. And not 1, not 2, but almost, as you saw, 16, 17 winners. So the cutoff for us as a winner was anybody who's given us about 10% of that particular fund corpus back or more. And pleased to say that there were 17 such startups in that first cycle. And I mean, not that we're saying that the other journeys were any less. People went on for 5 years, 7 years, 8 years. So entrepreneurial journeys are never easy. But on the other hand, investors cared about the winners and what they did in terms of returns. And as you can also see, there's a massive skew, just as all of venture capital keeps talking about. But you seldom see the results in public view. So we wanted to show those results in public view and actually demonstrate how the power law plays out. And so that's exactly kind of what we released the report for. So the bulk of the capital is realized by these 17. It's about 20% of our entire 5-year journey. But even within that, if you saw 3-4 of those startups deliver half of those wins. And so it was a fun exercise to be able to demonstrate all of that and share it with the ecosystem.
Karthik, kudos to that. But, despite that impressive number in terms of the 5.7 times return multiple from each first fund, when you look at the company, Blume Ventures has actually encountered a bit of challenges also with almost, I believe, half of the fund's portfolio, which consists of almost 34 startups, are seeing a return of 0 capital. Could you just help the viewers understand and talk to us a bit more about that? What are these challenges? And, how does it shape up for you as the company?
No, I think 2 things. I think you have to contextualize. Very difficult for people who came into the ecosystem or born into the ecosystem as startups post 2015 to understand. Why I say that is because that was kind of the halfway point of that post 2008 to 23 journey. And India's startup ecosystem kind of took off once, Tiger, SoftBank, and all of these folks started getting more bullish. And that's all post 2015. In fact, there was a lull in 15, and then in 16 with UPI, UID, Geo all kicking in, we saw a massive second wave kick in. So my stance always has been that 75% of India's ecosystem has not even seen what happened before that. A lot of the ecosystem was born, both startups, entrepreneurs, VCs, LPs, Indian LPs, into the ecosystem post 2015-16. Now, what that means is that it was much more challenging to get capital, to get Series A, to get Series B prior to that. And the number of players that you're seeing today in the ecosystem, that number would be maybe 1/3 at seed, maybe half at Series A, maybe half at Series B, or even lesser, maybe 1/4, than what you're seeing today in the ecosystem. So while it was kind of easy to remark why there was a high loss ratio, there were not a large number of startups in the ecosystem. By the way, this was not an era where we were doing 400, 500 seed deals in a year, right? You see, even though this has been, last 2 years have been suppressed, you see a lot more seed deals. Back then, if you did 15, 20 as a fund in a year, people would say, oh, wow, like you guys are very, very busy, very active, and how will these get funded in the next round? So that fear did play out in the sense that it wasn't easy to get enough traction to attract Series A capital in the next round. And therefore, that value of debt, as we've shown in our report, was very, very deep. So you had to literally, be really top of the class, play into a trend line, impress one of the, dozen or so Series A VCs, and then you got capital allocated to be able to build the next part of the journey. Some of them miraculously survived despite that, but a lot of them, eventually give up. I mean, it could be personal considerations, it could be unsustainable, ability to retain their workforce and their team. And so I guess what we were trying to be was being as clever as possible in diversifying this risk by playing broader and keeping very tight stop losses. So if you put in today's context, these seem like, laughable amounts, but back then it was meaningful. We were getting valuations were 10 crores. With 1 crore, you could get 10% of a company. But also on the flip side, we ensured that we didn't lose too much capital in any one singular bet. So I think this report, we might have missed this, but in the next report, I will show you, it's still a year away, but we will show the dollar loss ratio versus the number of companies. So while you spoke of number of companies, I don't think we lost more than 15% of capital to those absolute losses. And that's how I think early stage venture should be played / that's how portfolio should be constructed. So that your capital at loss is always kept very tight. The number of bets don't matter as much.
Okay, that's great. But, Karthik, also just putting the spotlight on some individual sectors, specific names and specific sectors. And I want to just talk about one of them, that is being edtech companies. Now, many edtech companies have been founded in 2020, 2021, and they've raised record rounds, which are in terms of funding. But now when you look at it, a bit of a floundering that you're seeing happening there as well. And you've been quite a prominent investor in this sector specifically. So what's your view in terms of the edtech sector, as well as, the future that you see for this as well?
Sure. No, since we're talking about Fund 1, actually, of all the losses that we saw, 2 of those 34 were also in edtech. We were very cynical till 2015-16 about edtech. And then we went very deep. And you're right in saying Fund 2, Fund 3 is where we were very bullish. It's not like we're not less bullish, but we're more considered right now. The direction of risk has stopped. Now we're looking for specific silos that we are not exposed to. We've made a recent investment in a company called Virohan. We're on the verge of closing one more, which is sort of cross-border education for working professionals. So if you see, both the trend lines that we picked are towards employability as much as opposed to towards K-12 or prep, where we have enough exposure with Class Plus and Unacademy. You're right in saying that probably were overfunded to be a sector in the offline space that was almost always profitable, never required boatloads of capital to come in. Some of our portfolio and the rest of the ecosystem was trying to build new business models and took a lot of aggressive capital, some dangerously so, by overplaying that card instead of turning profitable soon enough. The rest, I think, have got the memo. Most of them who have enough reserves, I think, are going to come through by using the capital very, very conservatively and getting to profitability. Yes, there will be a whole bunch of people who are trying to do, extracurriculars and skills and a bunch of, areas which were hot in 21, 22, but are not hot anymore as we move back into an offline world. But I think I'm not a cynic enough to believe that we won't have, 10 12 unicorns still standing, upright, profitable, tall, maybe half of them public, over the next 5-6 years. So that's my kind of intuitive gut call if I have to take a sort of bet on the sidelines with you. So I think whether some of them will be from my portfolio or not, too early to say, but that's what I would still want to believe. There are companies like Eruditus and PhysicsWala, and they seem to be doing fairly well. I don't know them intimately as I do my portfolio, but I would be disappointed if 2 of those 10 companies were not in my portfolio by that point.
I want to shift gears and talk a bit about companies that are like Nykaa, Lenskart, Sugar, and many have clearly actually leveraged that physical expansion to create an omni-channel presence from digital to physical as well. So, how important do you think it is, to combine this physical plus the tech? What do you see the importance of, this omni-channel presence actually taking shape in the current scenario?
I think all the examples show that there was no option but to go that direction. We sadly were burnt a lot in Fund 1 in consumer goods, consumer brands, e-commerce. We have only one success story from that era, Purplle, to show for it. The others are more specialized, like Cashify, etc. But I'm just saying, if you look at Purpple's story, it had to traverse the same path of either private labels, and now will contemplate offline as well. We didn't need the offline as much as because we were a multi-brand marketplace. We focused on first building the private label capability ourselves at the back end. 40% of our revenue comes from there. And then when you look at the leaders in the space, First Cry going public next year, I hear Mama just went public. Lenskart is, I think, inevitably going to get there. Nykaa is already a story from 2 years ago. And then there's Sugar, and there's other companies which have kind of grown into that $100 million size. And the whole bunch of, if you notice, the whole bunch of smaller brands that are very sort of attractive for acquisition by the larger brands. ITC has bought a bunch. I won't be surprised if that trend line just keeps continuing, whether it's the Tata's bought Carrot Lane, paid a nice hefty sum. And if you look at Carrot Lane's entire story post the Tata majority stake ownership, it's been all offline, right? 200 plus stores. So I think what everyone realizes is that early adoption and a certain type of buyer persona emerges online, gives you a boatload of data, makes it a much richer sort of feedback cycle, which allows you to build the right product, invest in the right parts of the supply chain, get the margin structure right. And then when you get that confidence, if you want to grow the market size by 10x, you have to be offline as well. And so inevitably, Lenskart's become India's biggest offline retailer. First Cry, I'm sure, is the same. I don't know the segment well enough. And I'm sure Carrot Lane is on its path to get there as well. So it's fascinating how these were started as e-commerce kind of sites, but actually today are the largest retailers, period, in their spaces or in their subsectors. And this trend line, I think, will continue. I think we will rightfully have, again, a dozen or 2 dozen publicly listed companies by the end of the decade, all doing a version of the strategy. Some might go international. I think Lenskart is doing international as well to grow faster. So it depends on what growth levers you're picking, but it's either private label, international, offline plus online. Some might, depending on if you're Apparel, for example, you'll do multi-brand stores as well. I won't be surprised if that.
Right. So, you obviously have and you interact with a lot of founders, you invest in a lot of these companies. Is there anything that, you could mark out in terms of any sort of a checklist that you have or characteristics that you find out or, you watch out for or, from a company, and specifically any red flags that you see? How do you pick out those red flags, when you're assessing a company? And this is across the board.
So I think, we keep professing this, and we're now trying to show it by data. I think founders need to understand that India's never been or will never be an easy market. There's no easy money, right? You've got to work hard in getting unit economics right if you're building on the ground here. And if you're building cross-border, then you have to put in the effort of literally moving one of the co-founders to the US or whichever market you're chasing. and understand the customer from the local market lens of the US. And so whether it's SaaS, whether it's deep tech, whether it is consumer in India or fintech in India, there's got to be, so when you put all of those constraints, suddenly you realize that this is not there's no shortcuts and there's no short-term journeys here. So essentially you have to build for a minimum of a decade to even get to a size of unit economics, a profitability, a respectability to be able to exit in a grand fashion. And if I'm looking at it as a venture capitalist, I'm not looking for the 50, the 70, the $100 million outcomes are fantastic. They're great attempt at that great journey. But that's not what's going to move my, $200+ million fund. It was very different when you were running $20 million 10 years ago. But with 200 million, that's not what's going to move the needle. So effectively, it almost like rule of thumb is, can this idea fit into this market, run by this co-founder? Are they capable of building a team that builds $1 billion outcome? And for that, you need a X $100 million revenue, not GMV, net revenue, path to profitability, if not already profitable, to be sort of acquired at scale or go public at scale. So I don't think there's shortcuts to that. And I don't think if anyone comes and tells me they can do that in 5 or 6 years, I'm not believing it. So firstly, there's the 10-year journey. And here's the other second level irony. The 10-year journey is good enough for me as a VC, but if I exit, who's buying my position? Is it the public markets or is it a strategic like the Tatas? The only reason either party would buy that is if they believe that the business is solid enough to be built for another thing. Nobody buys to give you an exit if they can't multiply that wealth by the same 20% compounded over another decade. So effectively, the bar has become so high that when the founder walks in, I'm essentially seeing whether they actually have the compulsion or the capability to build this for 20 years. It's such a high bar that it makes one's life a little easier because it eliminates a lot of plans very, very quickly. Because founders are not equipped to think in that fashion. They think it's fashionable to do a startup. And it's good at one level that it's become, common belief that anybody can start up. But it's bad that you don't think through why you're doing this or why you're asking for institutional venture capital, which has a very, very high sort of bar for their expectations and what their end state goal should be. I wish our funds were as small as our first funds, where even $100 million outcome is needle moving. That era is almost gone for Blume. I can't speak for all other managers. And therefore, our bar for entrepreneurs is very, very high. And we're looking at these three characteristics, basically. Ability to build super long-term, understand that they're building into a very large market, and so they might have to move wherever the customer takes them. And three, are they a people person? Can they build a team that can outlast them?
Okay, those are some of those important checklist points that one should keep an eye out on. But, what would be some of the specific focus areas that you will be looking at going forward? Any promising sectors that you find right now?
So I think if you believe that India is well on its way to triple its economy, I don't think we should get obsessed about the timeline, whether that happens by 2035 or 2040. When do we become an 8 or 10, 9 or $10 trillion economy? It's not as material as the fact that it's going to happen, and do we have belief in that? That's why I think LPs give us money from overseas, and that's why we give entrepreneurs money. If you're doing that, essentially our belief is that as per capita, that one fundamentally, the money flow, if you're sitting in the money flow, which is fintech, there's a huge opportunity set. Because the first thing you need to solve for is money, right? Whether it was payments some time ago, then it was investments, then it was lending. So all of these, I think, are not a winner take all. These are all, they can be like there are 20 insurance companies in India or 25 in general and life, right? And so inevitably, I think that kind of a modular sort of opportunity exists in every element of fintech. So fintech is evergreen in my view. And there will always be disruption because the infrastructure keeps changing. And there is therefore an opportunity to build very large companies in fintech. The second is, as you're seeing from these early trends in consumer brands, I think it's just the beginning of the cycle. So you're going to see new brands be able to build challenger brands, cater to sort of new personas, buyer personas, whether it could be youth, it could be, women, it could be tier 3, tier 4. And you're solving for buyer behavior that wasn't there before. And you might say, oh, the market seems a little small. I think what will surprise people is that over the next 5-7 years, as conspicuous consumption increases, those brands are best positioned to take off and get the lion's share of whatever new consumption power exists in the ecosystem, in the country as a whole. So I think those two segments are very interesting. Now, things like education, travel have been difficult to build very large business because they have predominantly offline components. They're very tight margin structures, and so not as easy. But I think if you build uniquely, you can build. So that's why I said I'm not lost hope on them. And then both, if you look at our portfolio and the larger universe as a whole, I think we're beginning to gain confidence that we are good enough to compete with the rest of the world on technology. So if you look at our portfolio, 40% of it, again, and within that 40, it's split down the middle. We actually make a conscious attempt to build at least 20% for every cycle in SaaS and in deep tech. And I think our ability to win against the world is getting more and more established.
Lastly, Karthik, I do want to know about those recent IPOs. We have had concerns about valuations for a lot of these companies as well, listed now, but, then you see the fall coming in. So any thoughts on that? Your views in terms of, valuations of the companies, how is that shaping?
I think it's a win-win-win for everybody. Phenomenal liquidity pools the minute you go public. Price discovery is as legitimate as it can get because essentially you're under the scrutiny of hundreds of pairs of eyes, equity analysts, people who want to buy in the market, mutual fund managers. And then if you're overpriced, underpriced, it resets very quickly. Second is when you do have comparables in the public markets, it starts influencing the right pricing in the private markets, which this is why you saw sharp corrections in the US much faster than in India, because we don't have as many public benchmarks. So the fact that all these markets auto-correct and then start stabilizing is when capital will come in, actually, interestingly. So when people say, when will the downturn stop? It will stop when there is fair pricing in the market and people know both entrepreneurs and VCs know that this is the right price for the asset. And for that, everyone looks towards public markets, but usually in the West, that's what happens. But here we don't have enough benchmarks. So I think it's fantastic, both from the eventual liquidity that I have to give to my LPs, from price discovery, from deal momentum and volume, and for the end state that everybody's looking for. Are we building sustainable, profitable businesses? And then when you put it under the IPO sort of filter, then everybody builds a little better. So I'm bullish that this trend line continues. We have anywhere between 10, 12, 15 IPOs in tech per year for the rest of the decade. I think companies like First Cry were not born yesterday or 2014 or 15. They were born in 2011, right? And so from each one of those eras, the guys who have survived and built to that proximity to profitability are all ready, in my opinion. So in the next 2, 3, 4 years, I think we will start seeing more examples. And I think we should stop obsessing about the idea that these have to be $1 billion or 2 or 3. A lot of them will start IPOing at 200, 300, 400, 500 million, which by Indian standards is a lot. As you know, with the rupee at 85, we are talking about 200 million being 1,700 crores. It's not anything to, laugh or cry about. It's a very legitimate IPO. And we should encourage more companies to start going public as early as they start sensing profitability and a predictability in growth. That's what markets want to see. I don't think everything else, all the other arguments are vanity arguments in my view.
Okay, Karthik, thank you so much for joining Nath this evening on ET Now. It's a pleasure having you on the show and pleasure understanding, in terms of Blume Ventures and what and where you see, how do you see the red flags coming in for companies? What is the fund looking at doing with them as well? Thank you so much for joining Nath, Karthik.